Property and casualty initial licensing. This is going to be Chapter 15, crime insurance and bonds. Crime insurance is going to be added to a CPP or written on a monoline basis. It's going to have a deck page that's going to cover all the following things. Again, in this case, if a limit or premium are not shown, there is no coverage, just like on any other policy we talked about. So the first section here is going to be for employee theft and also known as employee dishonesty. Second section is going to be forgery and alteration. Third is going to be inside theft of money and securities. And inside refers to inside the premise. We'll go over these in a second. Inside robbery or safe burglary of other property. Outside the premise. Computer fraud, fund transfer fraud, and money order and counterfeit paper currency coverage. So a couple definitions that we need to go over here at the beginning. Custodian, this is any person that has possession of the property inside of a premise. A messenger, this is going to be a person that has possession of property outside the premise. Remember, theft is going to be defined as any unlawful act of taking that is without the owner's consent and includes the crimes of burglary, robbery, forgery, and other crimes. Again, burglary is going to be theft from inside a premise. Visible evidence of forcible entry or forcible exit is required for the insurance to cover, but the actual entry is not required, so you can reach in through a broken store display window and still have that as evidence of the forcible entry and have the coverage. Robbery is going to be defined as theft of property in possession of a person. It involves always a face-to-face confrontation and requires either violence or the threat of violence, but an actual weapon is not necessary in a robbery. Employee dishonesty insurance. So this is going to be covering losses from theft of money or securities or other property by employees. In this case, the police must be notified in the event of a loss or a claim will not be paid. One additional condition is that coverage is automatically canceled on any employee when the insured discovers, aka learns of, the employee that has been involved in a dishonest act at anywhere, anytime, whether or not the act occurred prior to employment. So there are 3 schedules for employee dishonesty insurance. The first schedule is going to be a name schedule. This is going to be specific names like John Jones, Mary Smith, etc. Position schedule, this is going to be for certain positions like clerk, cashier, manager. And then the third schedule is going to be the most expensive, usually not used, which is going to be all employees. Note that there is no such thing as a named position. If you see that, that is made up, Mickey Mouse, not real, and not to be chosen as an answer. Forgery and alterations coverage. This is going to cover worldwide for any loss of money resulting from forgery or alteration of outgoing checks or drafts or promissory notes by anybody other than employees. Inside theft of money and securities inside the premise is going to provide coverage for loss of money and securities from inside the premise or banking premise resulting directly from theft, disappearance, or destruction. Inside the premise, robbery or safe burglary of other property is going to provide coverage for loss or damage to other property inside the premise resulting from an actual or attempted robbery of a custodian or from a safe or vault that is inside the premise. And then inside robbery or burglary of other property, this is going to cover the loss of other property because of burglary. In this case, again, you have to have the visible evidence of forcible entry or exit required for the claim to be able to be covered. And that is the end of the extent of generally what they test on crime insurance for the Texas insurance property casualty initial licensing for general lines. Now we're going to talk about bonds. Bonds are not insurance. Right. Just one thing to make sure to say right from the outset. Yes, we're giving you a license here, or getting you prepared to get a license for insurance, but this also allows for you to be able to be licensed to sell these bonds, even though they're not insurance. So there are 2 types of bonds. There's surety bonds, which are guarantees of performance. and fidelity bonds, which are guarantees of honesty and trust. Now, there's three parties to a bond contract. The principal, also known as an obligor, this is who makes the promise to, and the promise is made to the obligee, also known as the insured. This is the one that takes the promise from the principal or the obligor. And the vehicle in which they enforce the promise is through a company called a surety or a guarantor. This is who is backing the promise that was made financially. Now, if you do not hold up your end of the bond, right, then the process of suretyship, which is a penalty payment that is made for breaking the bond promise. So this is going to be something that is not typically expected to be done. Bonds are not expected to pay out. So in this case, they do not want that to happen, and generally don't expect it to happen. Okay. So example of who may be whom in these situations, a school district could be an obligee that's requiring a contractor that would be the principal to complete a building by a specified date. Say maybe they got school coming up and they need a new school building. So in the case of this situation, the principal or contractor would purchase a bond from a surety company, also known as a guarantor, for a specified amount and would be payable to the school district in the event that the contractor was unable to meet the specified deadline. Right. So the bond is guaranteed that if the principal defaults on the contract, the surety will be financially compensating the obligee. The surety guarantees that the outcome will occur as contracted, and if it does not, the bond will pay the financial consequences to the obligee. But unlike insurance, the principal is responsible for reimbursing the surety the amount paid under the bond. The obligee has the right of first recovery against the principal, and the surety has the second rights through subrogation. Okay. So understand that you may have a situation in which the insured or obligee needs to make sure that something's going to happen on time. Say that school district wants to look at several different contractors to do that, or several different principals. So they may go through a process of what we call a bid bond. And a bid bond is just a guarantee from the surety or the guarantor to the principal and to the obligee, therefore, that if the obligee awards the contract to the principal, that the surety will issue a bond to that company so that the process can go forward with a bond. Performance bond, another name for this, is called a completion bond. Understand that there is such a thing called a payment bond. This would be typically used for transfer of ownership from a general contractor to a owner of a property after the property has been completed, to ensure that the labor and materials will be paid and not transferred over to the new owner and stay with the general contractor. Other types of bonds that we're going to be talking about here will be court bonds. The party that is seeking the remedy is called the principal, and the party against whom the action is taken is the obligee. In a fiduciary bond situation, this is anybody that's entrusted with the property of others, like the executor of a will, for example, would require a fiduciary bond. A bail bond. In this case, the obligee is going to be the court. The principal is going to be the accused that is supposed to show up at a specific time and place. And the surety is going to be the bond company, right? So if you don't show up at the time or place, then the surety is required to pay money to the court. And the only way they get the money back is if they make the principal show up, and then they can get recompensed on the bond. Certain municipalities do require, or certain types of businesses do require, license and permit bonds. Things like notary publics and certain trades and certain municipalities need these to ensure compliance with the codes. And then the last part here is going to be fidelity bonds. These are guarantees of honesty and trust. In this case, the obligee is the business, the principal is the employee, and it protects the business from larceny of the employee. Generally, the employee will not know that the employer has purchased this contract. And again, this isn't true crime insurance because it's a bond, not insurance. All right, so we've got some questions that we're going to go over in this section here. Number one, in a retail business, all the following situations could be considered theft, except A, merchandise being stolen with evidence of forced entry. B, a clerk witnessing a customer shoplifting merchandise. C, a clerk being robbed at gunpoint. Or D, the store's year-end inventory coming up short by 5%. Number one's answer is going to be D, the store's inventory coming up short by 5%. That is not going to be considered theft. Number two, the employee theft provides coverage for theft of money, securities, and other property by employees. There are 3 schedules available. They include all the following except. So what is not a available schedule for employee theft coverage? Would it be A, a named schedule, B, a named position schedule, C, a position schedule, or D, a blanket coverage? In this case, B, a named position schedule is Mickey Mouse made up, not real, and is the incorrect option available. A, C, and D as all employee or blanket coverage is all going to be options that are possible. Number 3, the 3 parties to a bond are going to be A, the principal, obligee, and surety. B, the obligor, the principal, and the surety. C, the principal, the obligee, and the obligor. Or D, the insured, obligor, and the principal. In this case, it is A, the principal, obligee, and the surety. All the other ones have duplications if you look at the alternate definitions for each. Number 4, a bid bond A guarantees that if the obligee is awarded the contract, the obligee will furnish a performance bond. B guarantees that if the principal is awarded the contract, the surety will furnish a performance bond to the principal. C guarantees the lending institution, the supplier, will furnish the material to the bidder. Or D guarantees the work will commence on schedule. So a bid bond is defined as B, guaranteed that if the principal is awarded the contract, that the surety will furnish a performance bond for the principal. Number 5, a performance bond. A guarantees the obligee that the principal will complete the contract as agreed. B guarantees the principal that the obligee will complete the contract as agreed. C guarantees the principal will be paid by the obligee on time. Or D, none of the above. Okay, in this case, this is guaranteeing that the obligee will, that the principal will complete the contract as agreed. Number 6, which of the following must be true in a burglary? A, property must be taken from a custodian or a watch person. B, there must be no evidence of force or violence. C, the burglary must involve acts of a convicted felon. D, there must be unlawful entry or exit from the premise with visible evidence. Okay, for number 6, this is D. The unlawful entry or exit with visible evidence is required in a burglary. Number 7, the judge orders a person under arrest to post a bond or to be released. What is the person under arrest called? A, the obligee, B, the bailee, C, the surety, or D, the principal. So in this case, under number 7, the person under arrest is going to be called D, the principal. This is the accused. Number 8, the employee theft coverage would pay in which of the following situations? A, the store owner knew an employee who stole from the store had shoplifted before hiring them. B, a manager was robbed of a bank deposit when away from the business premise. C, the burglar entered and left through an open skylight. D, the insured refused to notify the police about an employee theft. So the only one that could pay out would be B, a manager that was robbed of the bank deposit when away from the business premise. The other ones would not be able to be paid out. The first one wouldn't be able to be paid out because they knew about a dishonest act before hiring them. The C would not be able to be paid out because there is no evidence, visible evidence of entry or exit there for the burglary. And D, it is required that employee theft be notified to the police to be covered. Number 9, a person that is desiring to be a notary must secure which type of bond? Would it be A, contract, B, judiciary, C, license and permit, or D, fiduciary? In this case, it is a license and permit bond for a notary. And number 10, a fidelity bond protects in which of the following situations? A business owner from a shoplifter, B, an employee from a robber, C, an employee owner from a pension fund mismanagement, or D, a business owner from an employee theft. This is only going to cover in the following situation of a business owner from an employee theft, D. All right, that's the end of the section, chapter 15 on